momento. Bueno, creo que ya tenemos a nuestro siguiente invitado, a Edward Williams, multi-asset investment strategist en AllianceBernstein. Edward, good afternoon.
Good afternoon. Thanks for having me.
Thank you for giving this interview for Negocios Televisión, Edward. We've seen a decent start of the year for markets. What's driven it? Do you expect this good start to continue?
Yeah, I think for stocks in particular, Q1's been pretty good. US markets were up about 10%, Japan roughly the same, Europe a healthy 6% or so. And I think in general what we've seen is equity markets shrug off this higher for longer narrative and focus more on economic and company-specific fundamentals, which both have been pretty good. Returns for bonds, on the other hand, have been a bit more mixed, I would say. We, of course, saw a very strong rally towards the latter end of last year as fixed income markets moved quite aggressively to price in this soft landing scenario. And so far this year, we've seen government bond indices and government bonds give back some of those gains on the back of hotter than expected inflation data. So government bonds flat to down so far this year. High yield, a little bit of spread tightening has led to some modest positive returns across the first quarter. In terms of the kind of the second part of your question, what do we expect from here? I think for equity markets, we think that there's likely to be a refocusing on corporate profits, and to the extent we see continued optimism around earnings, we expect equity markets and equity returns to broaden somewhat from the extreme kind of concentration and narrowness that we saw last year. For fixed income markets, I think there'll likely be continued volatility as investors continue to sort of navigate their expectations around rate cut timings. But in our view, I think things are set up fairly well for fixed income returns, with high kind of starting yields typically a good indicator of positive forward returns.
You just mentioned interest rates. What's your view from here? When do you expect to see the first rate cuts?
So it's been our view since the start of the year that the markets were perhaps getting over their skis or a little bit ahead of themselves in terms of pricing in rate cuts. So at one stage, I think we had 6 or 7 rate cuts priced for this year, starting as early as March, and that since has been rolled back fairly quickly. Our view in the US is we expect to see 3 25 basis point rate cuts this year, starting in June or July. I think once the cuts start, the pace or the cadence will be driven largely by the strength of the US labor market. If we do see, I'd say, kind of firmer or hotter inflation data over the next few months, that might mean a slightly later start date, while any kind of material weakening in the labor market might mean a more sort of aggressive pace of easing. So largely dependent on what we see in the data in the next few months. I think in Europe and UK, it's a similar story. We expect the ECB to begin from around June and the Bank of England maybe slightly a month or two later than that. But I think it's clearly very easy to become fixated on the timing of these cuts, but I think it's perhaps more important to take a longer term view of this landscape. So the data that we look at AB is consistent with lower policy rates over the next few months. And I think the exact timing is perhaps less important than the overall trend, which we believe will be downwards.
So what does that view mean for your duration positioning?
So we primarily use government bonds to manage the duration and or kind of interest rate sensitivity across our multi-asset portfolios. And generally, over the past couple of years, given the extent of the volatility we've seen within interest rates, we've had to manage that allocation very dynamically. And I think that's likely to be the case moving forward as well. Within our kind of core multi-asset income solutions, we remain slightly overweight duration, and that is reflective of a few things. Yields are very attractive, so that gives us some income, which is great, but they also help to improve the diversification prospects versus riskier asset classes like equities or high yield credit. I'd say also if we end up in a hard landing or kind of recessionary scenario, neither of which are our base case, but if we do, duration or kind of government bond exposure is what you want to hold. So again, not our base case, but we think that it's important to have some exposure for risk management purposes as well.
Where else are you seeing opportunities across your multi-asset portfolios?
So across most portfolios, we have an overweight to equity across the kind of majority of our portfolios, but we are being very selective within that. Our focus is on quality companies with stable and profitable business models that should be able to continue to perform even if we see slowing economic conditions. We do think it's important, though, even within strategies that are investing for income, to maintain some exposure to these kind of mega cap tech names despite their low dividend yields, because this is really the area that you're going to get the best earnings growth. Therefore, you would think that have the best prospects for upside potential. And that naturally leads us to a slight kind of bias towards the US right now in terms of country exposure. Within credit, sorry, go ahead.
Interrupting, Edward, I thought you finished, but continue, please.
No, I was just going to say, like, within credit, because that's kind of a core asset class that we look at as well, we're focusing on kind of higher quality. So we're focusing on kind of the IG names. We don't think it makes a lot of sense right now to reach for yield. So quality within equities and quality on the credit side as well.
Where else are you seeing opportunities right now? Also, in the equity market, do you think that richer equity market valuations are something concerning you right now, particularly in the US?
So yeah, valuations are certainly one metric that we look at, and at an index level, they are expensive relative to history, and as you say, that's particularly in the United States. But I think if you dig a little bit deeper, they aren't actually as extreme as they may seem on the face of it. So if you looked at US stocks on an equal weighted basis, so something like the S&P 500 equal weighted, they don't actually look too expensive versus their own sort of 10-year average. And that means that there are plenty of companies with sort of underappreciated earnings growth potential for an active manager to find. Outside the US, valuations and kind of prices are generally lower, with shares in Europe and emerging markets trading kind of reasonably attractive versus their longer term history.
Mm-hmm. Edward, just to finish, where do we go from here, and what is important for asset allocators?
So where do we go from here? I think the good news is the global economy is in reasonably good shape. We do expect growth to soften and to slow, but crucially not into recessionary territory. Inflation has been stickier than expected in the last couple of prints, but we are confident that the general trend is downwards, and that should give policymakers room to ease, probably from kind of the middle part of this year, as we've discussed. So I think one other thing I would add to that, as we move through the year and kind of move through this election cycle, it's a very busy year for elections, the focus will likely turn to the US in November, and that will likely bring with it market volatility. So for asset allocators, I think in this type of environment, you need to focus on quality and stay diversified. I mentioned earlier how we see the diversification prospects of bonds returning, and we think that will be particularly helpful if we do see bouts of market volatility, or if we do see some kind of unexpected deterioration in the macro backdrop.
Edward Williams, multi-asset investment strategist at AllianceBernstein. It's been a pleasure to have you, Edward. Thank you so much.
Thanks for having me.
Bueno, pues desde Allianz